computer yet.
Yeah.
Okay, let's do this. Okay, Neda. So you guys just missed all this crazy technical stuff that we had going on. So thankfully you were spared. But this is Neda. This is Neda, who is my lovely, lovely insurance agent. I love her. I was so lucky to come into her world and have her as
Oh,
my
thank you.
wonderful insurance agent. So,
Well, I love you too, and you're great. So,
no, so okay, how long have you been doing insurance for?
about 19 years.
19
I've
years.
been, and I've been an independent, I'm a broker. I'm an independent broker. I'm not a captive agent. So we work with multiple different insurance companies. And I've been with the same agency, which is Alive Insurance Services, since 2004. So that is what it'll be 19 years, I think, this year.
It's a long time. So with someone with, so even like, so for myself, I've been in business over about 25 years in that range. And for someone who's been in the business in the same time of you or myself, you see a lot. You could foresee things, you can see what happens, with policies or how things could go wrong. And I think there's something said when you are in the business for a long time that you have all that knowledge of what you can see could go wrong, or you could just foresee a lot of things that come
Mhm.
about, right? So
Yeah. Yeah.
so I have I always call you for questions and concerns about clients. I'm in real estate, so I'm constantly working with clients that are getting insurance. And so there's been times where you've given me warnings and helped me be ahead of the game as far as how to um, be prepared for things that could go wrong. So what's your experience lately of what's been going on? Or
Yeah. Well, there's been a lot of change. And I think you're one of the few smarter realtors who actually looks at things ahead of time. Because I think what's happening now more than ever is that people are getting into insurance binds, not expecting that to come about. And it isn't necessarily any longer based on just the location. There's lots of factors now that are playing. And so, one thing that's happening is it started with rate increases, right? So the carriers have to put in rate increase improvements, or they want to get it passed through the Department of Insurance. So when they submit these approvals for the rates to be approved, either it's going to get approved or not approved. So um, most of the time, if it's a reasonable rate increase, the state will approve it and will say, sure, no problem, like 2%, 3%. Well, in the past 3 months, a lot of carriers have been ramping up to get their rates in and for them to be approved. And State Farm is a good example of this. I am not a captive agent, nor am I a State Farm agent, but I think from what I understand, they had a hard time getting their rate increase approved. And so in the state of California, a lot of insurance companies feel that they're not getting adequate premium for what they've paid out in the past few years. It started with the fires, and then it went into these last storms we had. And although things like, rainwater collecting, like flood is not covered, there's a lot of water damage that came into homes because we just haven't had this type of crazy weather in so long. And then we have all of our expensive cars on top of it. So a lot of times you think to yourself, okay, well, I've got full coverage on this Tesla, and what used to cost $200 to $500 to replace a bumper, now it's $2,000 to $10,000 depending on the car to replace a bumper. So the insurance companies are saying, look, we are putting out a lot more money than what we're getting back in California, specifically Northern California is costing us a lot of money. So we as what do you call it? On the client side of it, like if you're a homeowner and you're purchasing the insurance, obviously you want it to be the best rate. You want it to be cheap and expensive. You want to pay as little as possible. But what's happened in the past 5 years is that actually kind of slapped us in the face, because we have put in so many rules and regulations and prevented the insurance companies from increasing incrementally each year, where they feel, and we've seen numbers, they have fallen into a deficit where if they keep saturating in certain parts of California, they're going to end up going under. There's only so much they can pay out. So with the fires, we started seeing closures of zip codes, of areas where the insurance companies no longer wanted to do insurance, which made sense. And then slowly, as all of these other things started to happen, we started to see them limit more and more certain other zip codes, and even some carriers have now left California, unfortunately.
Hmm.
A lot of our carriers, thank God, have gotten their rates approved. We are seeing complaints from clients, but what everyone needs to really understand is that there is no flexibility right now with insurance. And honestly, you'd rather have what you have than not, because the alternative is going to be either horrible coverage or a lot more expensive.
Hmm.
Um, and so it's that kind of was the start of it. And then in some, like in California, the carriers that have left, we have no idea if they're going to come back, which kind of dwindles down our choices.
Hmm.
So we knew that the zip codes were going to be a problem. And in all honesty, I think a lot of us thought that that would get better as we didn't have fires, but then we didn't see the storms coming, right? And so
Right.
now you have a whole other issue with all of those claims. So the number one thing I always tell my clients, and this is a really good takeaway, is please stop filing small claims. A lot of the captive agencies that don't have brokers, where they don't work for the client, they work for the insurance company instead. When you call to file a claim, the first thing they say to you is, sure, great, no problem, let's open a claim. And I've had this happen where clients refer to me, they've had small claims of like $800, and it's prevented us from moving forward, even though we think to ourselves like that's no big deal. So
Hmm.
the claims has been a big issue, and then carriers not wanting to be saturated here because they're scared of having more losses, and then of course the rate increases being approved or not approved has kind of led some companies to make changes in California, like State Farm, who left for now. And we're hoping they'll come back. Actually, I actually used to refer to a lot of State Farm agents that can do policies in areas where I couldn't do them because but now that's gone too. So yeah,
You had
does that
mentioned
kind of
about not making claims, as you know, and I have clients that call me and say, "Oh, should this was quoted? Should I file an insurance claim? Or my plumbing leak? Should I file an insurance claim?" And just for me, just a natural thing I would say is just, if you could leave your insurance out of it, just leave it out. Just because I just didn't want it to mark. Does it mark the house or does it mark the house or the insurer itself? Like when people call on a claim.
So if you own a house and let's say you decide to buy a new house and move, the claim follows you.
Okay, so it's for the insurer.
So for the insured and the location, the new buyer who's buying the house that you're selling does not carry that claim. If the claim is newer and it's showing open, we now are getting blocks where the insurance company wants proof that the seller has fixed all those issues and that the buyer is not getting in. And in the Bay Area, what the insurance company doesn't understand is barely anybody can ever sell a house that has had no claims that weren't fixed, because
Mhm.
most of our homes are nicely updated, with the pricing goes here, like most homes aren't falling apart, most, right?
Got you.
So, but with the claim, it follows the owner for 3 to 5 years, and some carriers have different rules. And usually your premium goes up, which then sometimes it's not worth it. Sometimes you end up paying more than what you would have just paying for the claim, but then insurability becomes a problem. So, what I always tell my clients is, look, if you have a claim and it was $800, and a year later, half your house burned down, a $300,000 claim carries just as much weight as an $800 claim, and now you have two claims against you and you're basically uninsurable. So a lot of times clients get frustrated, but it really does harm you. So you always want to make sure that your claim is worthwhile making, which is why most of my clients carry larger deductibles. Like a $2,500 deductible is very reasonable. It saves the money on the premium, but then also we can ensure that they're not going to file a small claim. In my mind, really, you shouldn't be filing a claim smaller than $5,000 if you can at all try to help it. And for some, it could be a hardship. And so they may have to, right? I mean, people have to do what they have to do, but if you can prevent it, that's really something that would be a good thing to do.
That's a good point. So if you have a higher deductible, it prevents, just smaller claims, because you should be able to take care of it or find a
Yeah,
way, and then avoid
yeah,
filing claim if it's under 5K.
yeah, exactly. I mean, I just would recommend getting lots of bids on that job to see if you can find the most reasonable priced person to come to the job so that you can try to afford it. And that way you don't file the claim if at all possible. I think one of the biggest pet peeves, the biggest claims I see that's really bad is when people have their personal property stolen out of their vehicles. This is a big one right now because there's so many car break-ins,
Right.
and they file a claim for a laptop or like an iPad or maybe their purse or bag or whatever. Yeah, don't do that. Don't do that because it can go on your homeowners and people don't know it and they do it. And then it's such a small claim, it just doesn't make sense.
Ah, that's interesting. Okay, I mean, I could see how that's happening a lot, because there's so
Yeah.
many, I see it on my feeds all the time.
Yeah.
All these videos where people are just breaking in
Yeah.
and stuff. Okay, so that's good to know. I haven't really thought about that yet.
Yeah,
Uh,
because sometimes too, the claim makes, so if you, let's say you are gonna be insuring a house that's kind of difficult to insure already, it's like borderline in an area that could be hard to insure, then you throw that claim on top of it from a previous property, it's just too many whammies, you know what I mean? You wanna make it as lean and clean as possible, to be able to be as insurable as possible right now, because companies are so picky right now. Yeah,
That's good to hear because, especially in the Bay Area, of some areas right now in San Mateo County, Santa Clara County, some it happens too in San Francisco where you have to do fast closings and
yes,
in different areas, but fast closings and no contingencies. And so I just called you recently on a property I'm trying to close in 2 weeks. Um, and when so what I usually do is I call Netta and I say, hey, Netta, I have a property. Can you give me an idea on quotes? Because you also have to give that quote to the lender. And that's how everybody could figure out their numbers. And, she ran the property and said it would take about 2 weeks to actually get it from underwriting to see if that's something that the property would get insured or not, right? And so in
right,
that case, if you don't have an insurance agent or a contact with somebody that you could call and right before you're writing the offer, or immediately right after when you're writing the offer, as long as there's contingencies, you can know right away where you're at. But she told me that probably take about 2 weeks. So we just had to switch gears and figure out what other way we can go about getting insurance. But
yeah,
that could be pretty tricky, for folks who don't, right? Especially in high fire areas or,
yeah,
you know,
yeah. The 2-week block is new. So the first issue I talked about, which is like seeing the future and things that are new and problems that are rising, was just location, insurability, and rates being increased.
Mhm.
The second thing that's happening is a lot of insurance companies are now becoming a lot more intuitive. They're using a lot of computer programs, and also I think they use a lot of drones,
Mhm.
because what happens is when they see the house is built, like let's say less than 1960s, especially in San Francisco where the majority of my clients are, where the homes are built in the early 1900s, some carriers now what they're doing is they're blocking that house unless, I think my suspicion is, unless they have like permit history that the house was completely renovated. What they do is they block us, and it's a 15 to 20-day block where they want to see inspections and proof of updates, and a lot of that, the timing goes beyond the close date. And so it goes through what we call an approval process, which used to never exist. And so what you're talking about is one of those situations where the house somehow triggered them to put it through approval. And the approval could be either a yes or a no, and it could take 15 to 20 days. Well, if it's a no in 15 days, then you're scrambling on a house that you're trying. So it almost is making it hard for us to insure with them. And that's kind of their goal. They're trying to kind of scare people off from continuing that process with them because really what they're saying is, we don't really want this risk.
I can see that. So it is getting pretty tricky. What stories can you share with us recently that you've had where it's just good learning lessons for the agent or yourself that came about?
I think there's a couple. It's been so many fires lately, like putting out fires, people. One of them is I think people still don't really understand that updates on our home are very important. So
Mhm.
knob and tube is a big one. So I have a client that went through a captive agency. I'm not going to name names, and they try to get insurance. The agent knew very well that there was knob and tube present. They knew that the house did not qualify for with regular insurance. And what they did is they ended up giving it some sort of a limited policy that excluded a lot of things. Well,
Mhm.
when it came time for the evidence to be presented to the bank at the last minute, the bank was reviewing it and they kicked it out because it wasn't a valid homeowner with dwelling replacement, how they want it to be included for everything.
Hmm.
So the buyer was frantic, the realtor was frantic. They were just beside themselves because nobody really thought to review the policy in detail and to see if there's any exclusions and if the policy was actually valid. And it was really dirty on the agent side too, to try to pass something off as normal and not educate the client on what it is. So number one thing I think is really important is if someone is using an agent or somebody that they know well that they're using, is to always ask, is this a regular homeowner's? Does it have any exclusions? Am I going to have any problems with any types of claims that I would have to get paid? Minus earthquake and flood. Those are never included, of course. And just find out, because sometimes that can cause really big problems. I was able to come in and get them what they needed to close. It
Mhm.
was a lot of work, but it worked out and it was fine. But if that person didn't have a connection with me and I didn't help them, they would have lost that whole deal because the insurance company couldn't get the bank what they wanted. So that's the one thing I've seen lately, which I have seen unfortunately happen with carriers that have done this. I don't know why they're doing it. Um,
Hmm.
the other one, let's see, there was one I thought of and I just,
How about like the $6 or $12,000 policy prices that you've come up?
yeah, so, oh, I have a good one. Yeah. So I have a gentleman who didn't check or vet a house in San Francisco. It's a pretty big square footage, high value home. And he just put an offer in, got the offer accepted, and it had a very old roof. And so what happened when he came to me is everybody blocked it because they couldn't, I think, figure out any type of permits that had been pulled for the roof. The roof was well over 35 years old. And so instead of paying like $3,000 a year, he's paying about $16,000 a year right now for insurance until he can go ahead and spend the money and do all the updates. And then he could retry to go with a normal carrier. So I think that's also key, is to really vet the house before you get into a situation. Also, what I have told insurance for realtors, this is really important, is you really should be putting insurance contingencies into the offer. And quick closes of like 10 to 12 days really need to stop. And any mortgage lender that you know that you have a relationship with, they have to understand that the insurance market is not at all what it used to be, and that agents sometimes need time to get the client the best policy for the best price. Because if we just throw any policy out that's going to meet their demands, like I'm saying, the client might pay more than they need to.
Uh-huh.
So I have said to a few realtors, which they've reached out to me like this, frantic and figuring out what on earth they can do, is if you could just put a contingency, even with a cap number of how much your buyer is willing to pay for insurance, that naturally will omit all of the carriers that are surplus lines that would go into the 8, 9, 10, $15,000 range. Does that make sense? So that is a good one. And in some areas, especially if it's like Oakland Hills, up like closer to the Berkeley Hills, areas where Orinda, Lafayette, parts of Walnut Creek, those areas are impossible to insure, very difficult. So
Mm.
I think it doesn't hurt to put contingency in, just to protect the buyer, because sometimes even in the end, I can't even help them, or they're not willing to pay the $10,000, $15,000.
Got you. So you're seeing that so basically Orinda, Walnut Creek, and some areas in Lafayette or even Oakland, right? If they're close to brush zones or fire zones, you're
Yeah,
finding that
yeah,
insurance companies are just not wanting to insure.
yeah. No, anything hilly, you've got areas in Marin County, Mill Valley, parts of San Anselmo, Fairfax, where it's just very woodsy, Oakland Hills, Berkeley Hills, even parts of El Cerrito that go up into the hills. Anything that's closer to the city, even in San Francisco for the first time ever, which is really rare, our carriers rejected a client who just bought a house and got into contract way up high in Twin Peaks, where there's a lot of eucalyptus,
Mhm.
and they wouldn't take it, except for I did find one carrier that took it, thank God. but they had a lot of leniency because their close was very long. So
Mhm.
we can wait for the 8-day approval. And thank God, just this morning I got the approval. So that's what I'm saying is sometimes time is really key, and
Mhm.
quick is no longer very helpful. It makes things actually worse.
Yeah.
So yeah.
No, I mean, all that is very helpful because, when people are especially trying to make deals work, especially for myself and people in my position, I have a lot of agents and there's a lot of new agents out there. And if they don't have that experience, the last thing you want to do is just be in a situation where you're frantic and trying to.
Exactly. Yep.
How
I
about,
think that's also key. I mean, that's a really good point. I think using an agent like yourself who's very knowledgeable because you're protecting them in all honesty, and you're not really looking at the end result of making a dollar. I think that's really important because right now everyone needs that. They just need that extra eye to try to help them get something that's going to be easier, if that makes sense, and affordable. Like you don't want to pay a lot if you don't have to.
for sure. And so you've helped me on making sure they have good insurance policies for the properties the situation they have. So one is there's a lot of flip investors out there, right? And people who are buying properties to flip and fix, what kind of
Hmm.
insurance policies would you recommend for those? Because here's the thing,
Yeah.
a lot of them will just get regular insurance. And I'm like, no, the
Yes.
insurance agent tells me this is what you got to do it. So I think this is huge because many people are out
Yes.
getting normal insurance.
That's right.
Can you
Yes,
tell us
well,
about it?
exactly. That is actually very smart. So when you flip a house and you're doing course of construction or renovations, technically, when you purchase a homeowner's insurance is really only going to cover you for the perils of a homeowner living in the home and it not being vacant for more than 30 days. That is the agreement that you've made with the homeowner insurance.
Mhm.
So if you take a situation where you're buying the house, you're going to flip it, you're going to renovate it for 3 to 6 months, you're going to have contractors in there gutting things out, it's going to be vacant. You really run the risk of the insurance company walking away from a large claim if they feel that you were negligent and did not honestly answer correctly in the application what the actual house was going to be used for. So what you need to do is buy a policy, which is called a course of construction renovations policy. And that policy will cover you not only for the vacancy, for the renovations, the current building as is, and the end result. So let's say you start to rebuild the building. You bought it, it's 3,000 square feet, and you're going to gut out half of it and add on an addition. Now it's going to be 6,000 square feet. If you have regular homeowners and the whole house burned down 2 weeks before you're done with the renovations, you're missing 3,000 square feet. That's never going to get paid to you in that. So you're never going to have enough to rebuild the investment that you've made into the renovation.
Mm.
Does that make sense? So that's why those policies are very important. They're not cheap, but they're affordable enough where it should protect your asset. And you don't get it in conjunction with homeowners. You get it first, and then you convert it into a homeowner's when the work is done. Now, most important key thing here is the lender. The bank is going to want to see a homeowner if you are getting a conventional loan. So what does that do? It causes a problem because if they get the evidence request for the course of construction policy that we have to write, they're not going to like it.
Mhm.
So I think that's the one biggest issue I see a lot of times, clients who buy a house based on a regular loan because they like the interest rates. And then what they do is they turn around and they do these renovations and they want to do the renovations. And then when it comes time to providing insurance to the lender is not going to like what they see because it's not a conventional insurance policy. And it tells the lender that you're not moving in as a homeowner for however long the policy is. So that could be a problem. So the people who are getting loans to renovate, great, easy, no problem. The people who are getting loans as homeowners and they're going to eventually renovate, that takes a little bit of, that's hard unless the lender talks to them and is willing to be okay with it, which most of the time they're not.
Okay.
But
So,
you're absolutely right. You should not put your property and yourself at risk and keep the homeowners in place while you're doing massive renovations. Now, if you just redo your kitchen, no problem, right? Just a little cosmetic redo. They got the kitchen out, they replaced everything, fine. We're talking about like vacancy for a very long time, gutting out, walls coming down, paint, flooring, sometimes it's foundation work. Big work like that, you do want to make sure that you have the right insurance for it.
Okay, so if someone bought it as a primary residence and they decided, um, in 2 months, I actually want to just go ahead and I'm not really feeling the look, and I just want to go ahead and do the work then, like remodel, paint, do whatever, and and have the contractors do it before I really settle in. Can they get a regular insurance policy, stay there for whatever, and then
Yeah,
convert? So they
yeah,
can't.
totally.
Okay.
Yeah. Yeah, and that's just something they can do because that's in the beginning, it's what it is, and we would just switch them out and then cancel the current policy and then rewrite them back to a homeowners when they're done to move in. Yeah, that's actually, if you can do it that way, that's the greatest way to do it. But most people who buy homes they already want to renovate don't move in. And if it's only going to be like a 20, like I said, something minor, it's not that big of a deal. So they should really just talk to their agent about the risks and see if there should be changes that should be made. Yeah.
Okay, question. If someone intends to buy it as a primary residence, gets a normal insurance policy, after closing, can they convert it right away?
Yeah.
Or so they can convert it right away? Okay.
Yeah. I mean, if they change their mind and they don't want to move in, and 2 weeks after having their policy, we want to convert it, we can convert it.
Okay.
So now it all depends again on the insurability of the location as it is, right?
Got it.
So if it's difficult and we've gone through a vetting process to get them approved and they're approved, it'll make it tough because then we're worried. If they do this course of construction insurance, will they be able to get this policy back? Like, what if that location doesn't insure anymore? You know what I mean? There's always a little bit of a risk, but we work with that. We figure it out. And there's ways of figuring that out with them.
Okay, cool. So basically, there's workaround to that. And then how about when someone is renting a property? I think I'm
Yeah.
not a lot of people actually convert their home
Yeah.
insurance to landlord policy. So
That's really, really important. The biggest offender I see is people who own condos who move out and they don't convert the condo policy into a tenant occupied condo policy. Same with homeowners. If you ever move out of your home and you rent it out, or I've seen people who've gotten initially, like they're like, okay, yeah, I think we're going to move in, but then they end up not moving in. You really need to make sure you have a landlord tenant liability. The landlord policy is totally different than homeowners. The two most important key things it gives you is landlord and tenant liability in situations where you say to the tenant, hey, tenant, you're not allowed to have a dog. The tenant goes behind your back and gets a dog. Then the dog bites somebody. They come to sue the tenant. The tenant doesn't have much money. And oops, they didn't have their renter's insurance like they should have. They're going to go after the landlord. So then if you have a regular homeowners, well, you don't have landlord tenant liability, which means you are left on your own to defend yourself and to pay out the lawsuit for the bite. Second, most important thing, especially in San Francisco and places like Berkeley, where there's rent control, is when you have a tenant landlord policy, there is an endorsement called personal injury, which covers wrongful eviction. So if your tenant sues you for any reason, either for wrongful eviction or invasion of their privacy or whatever it is that they're trying to get money from the landlord, the personal injury on that type of form will cover those lawsuits against the landlord. If you have homeowners, absolutely nothing.
oh, I've never heard of that. So you said wrongful eviction. So someone gets
Wrongful eviction, yeah. So
the
personal injury, you always want to see that. You do have it on homeowners as well, but on the landlord policy, it really helps with things like wrongful eviction and tenant landlord, like tenant lawsuits against the landlord
So you
for
said that
tenant rights.
liability. Sorry, you said
Hmm?
that. You said that is a personal liability on the
Yes, it's called personal injury, and the personal injury pulls out of the liability of the policy for those types of situations. And the homeowners doesn't cover that. So that's the two most important things that I think those policies are good for. The third one is you have the loss of rents. So if you are renting your house for $4,000 a month and your mortgage is $4,000 a month, and the house burns, the tenant doesn't have to pay you rent any longer. You don't have to pay for the tenant to live elsewhere. But now the tenant's going to move out to a house that they can actually live in while you're rebuilding. And now you're paying mortgage, losing rent, and rebuilding. So in the landlord tenant policy, the insurance company gives you that loss of rent. So you at least are not without while you're rebuilding.
That's great.
Yeah.
So it's just for more rebuilding situations, or?
Yeah, I mean, it's usually when the tenant moves out due to some sort of peril, like, wind blew a tree down through the roof and now the landlord has to fix it. Well, the tenant's not going to stay there. So that the landlord, as they're rebuilding to make it habitable again, is going to lose rent because the tenant doesn't have to pay them rent in those situations. So the insurance company pays you that loss while you're rebuilding. And you should always make sure you have about a year of loss of rents on your policy.
Oh, wait, so you can click on how many,
Because I mean, it's not going to take you, it depends. I mean, if the house burned, it's not going to take you less than a year to rebuild it. So you want to make sure that you're at least getting 1 year of loss of rents,
Okay, I didn't know that there was like a time frame of that on a policy.
Well, I mean, you just kind of think like, how long do you think I might need this to be paid to me? Like if it's going to take me 8 months to rebuild and it's $4,000 a month, you just want to make sure that you have enough in your policy to pay that. So you kind of come out of pocket less as you're still paying mortgage.
Got it. That's really good. Okay. So a common question I get is, should someone get earthquake insurance?
I know. You and me both.
Yeah.
This is a big one. This is like the question of the world. And I think a lot of times people want me to be psychic because it's really hard. Earthquake insurance, I really do advise it because earthquake is not covered. So if you purchase a house in San Francisco, especially if it's on liquefaction and big earthquake comes, the house collapses, there is no insurance for that. So for peace of mind, do you want to take a risk or not take a risk? Oftentimes, I tell my clients, I advise it. It all depends on how much sleep you're losing over the fact that an earthquake may come and you may have a lot of damage. Some people don't mind the risk. They don't want to pay the premium and they don't mind. The key thing with earthquake insurance is that the deductible is a percentage of the coverage amount. So on average, the deductible is about 15% of your coverage. So if we use, and there's also like a 10% deductible, right? 15%, 20%, 25%. So that makes it very expensive because if you have a 20% deductible because it saves money on the premium and you have an $800,000 replacement cost on your insurance policy, you're looking at $160,000 deductible.
So you said a deductible is a percentage of the coverage.
Of coverage, yeah, the replacement coverage of what you have on the insurance policy. So if your homeowner's covers you for 800,000 replacement, the earthquake has to match that, and that's where the deductible is calculated. So a lot of people are like, well, for that amount, I would just self-insure. Well, it probably would cost you a lot more than 160,000 to rebuild the house. But earthquake, of course, because of the obvious reasons of where we're located, is very expensive here. If anyone is buying a house and they get word that the house was retrofitted, if they can get retrofitting documentation, there is a form that you can fill out where an engineer signs off on the retrofitting, where you could get 15% off of the earthquake insurance. So that's always a nice thing to look at if you are really worried and want earthquake, because then you get at least 15% off. It's still expensive. I mean, on average, I think my clients pay between $1,500 and $4,000 a year for earthquake.
Okay. So
and then you add the homeowners. Yeah.
Get discount.
You can get a 15% discount if you have retrofitted, correct?
Okay.
Because you're basically telling the earthquake company that, hey, look, my house is safer than others. I've had it bolted and retrofitted, and they're willing to give you a 15% because the risk of them having to pay out is a little bit less now.
Okay, so let's talk about umbrella policies. How often do you get people doing umbrella policies with you?
Every single time. I barely have any clients now that do not have umbrella policies.
Well, because you are good at making sure that everybody's covered. That's why.
They have to have it. This is like if you're a homeowner and if you have even $50,000 in a savings account, and if you have a good job and your income is decent, you have to have an umbrella policy. So I'll explain the definition of umbrella. Umbrella is strictly excess liability that covers over, like if you envision an umbrella over your home, auto, rental properties, boat, motorcycles, second homes, all of that is under one umbrella of excess liability. And the umbrella could be in 1 million, 2 million, 3 million, 4 million, 5 million. And it covers you in case the underlying policy falls short. The auto is the biggest offender. That's the biggest one. Mostly it's around accidents. You're driving down San Francisco on Fell Street with Golden Gate Park, bicyclist jets out. You're making a right turn, you hit him, he flies off the bike, lands on his face and neck, and he's, God forbid, paralyzed, works at Google, sues you for $2 million. If your auto only has 500,000, where are you going to come up with the 1.5 million? How are you going to defend yourself? Because once when the auto carrier has paid what they've paid, they'll gladly wash their hands of you and stop defending you because that's all they owe you. So the umbrella then, if you have one, would kick in with the legal defense, which is some of the best attorneys because they don't want to lose. And they would settle out of that 1 million, 2 million, 3 million umbrella to pay the difference of the amount that you're missing, which is the 1.5. So that's really important. And so then what happens is you prevent someone from tapping into your largest asset if you're a homeowner, which is your equity. The judge is going to say, sell your house. You've got a lot of equity. You've got $1 million there. You could pay it out quickly. So you don't want to lose your asset to reach into your own pockets. And that's what the umbrella prevents. I always get the question, how much of an umbrella is enough? Well, again, nobody's psychic. We're just kind of guesstimating to protect you the best way we can. I like to recommend my clients to have $1 of liability for every dollar of net worth. So if you have liquid cash savings of 500,000, you have equity of 500,000, and you make 250,000, you're already at 1.2 million easy, which means you should probably get a 2 million umbrella. You want to count everything except for retirement accounts, not 401ks. Those they can't be judged against. Yeah. Anything liquid, stock options, savings, income, equity, savings, like in different accounts, like some people have money market accounts that are liquidable. That is all really important to protect. They're very inexpensive. On average, for $1 million to 2 million, my clients pay between $150 and $300 a year for that. It's not, it's not expensive, but for some reason it's not talked about as often. And people just don't really know about them. So thank you for bringing it up. I think it's very important.
You have me covered all around. So
yeah,
it's very thankful, but I know a lot of people aren't as lucky. So I always just want to just drop them out.
That was smart. Yeah.
Another question, as far as Airbnb or short-term rentals, how does that insurance policies? Or how?
So thank God the market has changed, which is really nice. We have a few carriers, as long as the location is insurable, they do allow us to endorse Airbnb and short-term rental, which is phenomenal. Sometimes it's only like a $200 a year premium for that endorsement. It'll allow you to do short-term rentals. If you don't have that endorsement, it is not covered. And I would highly recommend not Airbnb-ing your house, because again, if a large peril happens and the insurance company finds out in the application process through the claim that you were short-term renting it, they can bow out or refuse to pay claim because you were doing something that was not part of the agreement you have with them. So you leave a big gap. And Airbnb insurance will not cover you. When they tell you you're covered, it really is not for that. So they won't cover the deficit of what your insurance should cover. Like, they're not going to pay you for your house that's burned down if the insurance decides to walk away because you were short-term renting it. But you should be able to get insurance now, which is good. That has been a nice change in the industry. So that's good. Same thing with lifting and Ubering in your vehicle. That's a no-no unless you have endorsed your auto to include that type of driving with your vehicle insurance. Kind of the same thing.
Okay, so for Lyft and Uber drivers, they have to have an endorsement for.
They should tell their auto carrier that they're doing that for a living and that they should be able to have a confirmation that they're covered for it as usage. Yeah.
Well, that's good.
Because again, the insurance company wants nothing more than to walk away from a large claim. You hit that bicyclist, they innocently say to you, hey, what were you doing? Where were you going? I was driving somebody, my Uber, to go to a meeting. You're not supposed to use an Uber. We're going to get out of this. Always that possibility. So you don't want to leave any holes or gaps.
Dude, I feel like we covered a great amount. Is there anything,
We did.
so thankful. Is there anything that you would say that we didn't cover that would be really helpful for someone to know?
Um, I just think one, everyone should open their mail because there's a lot of information that comes through the mail that I find that some of my clients miss sometimes. Try not to have your insurance be canceled. Make sure you keep up on your bills because right now getting reinsured is really difficult. And really understand your policies. It's very tedious. It's not exciting. It's a very boring subject matter. I totally understand, but really understanding what you have and what the agent has done on your behalf is really important. Because if that agent didn't do a good job or gave you something that you really needed or wanted and you didn't communicate with them because you didn't know, you could leave something undone where something won't be covered and you need that covered. Does that make sense?
That makes sense.
So,
That reminds me of a client I have has had no insurance on the property for the longest time.
oh wow.
And I believe she called you, but you said because it was tenant occupied and vacant. I mean, sorry, tenant occupied and had no insurance for many
No
years,
insurance.
that there's no policy that you could find.
Yeah. No, because they find out now. It's like I said, the systems are very intuitive. Same with auto. If your auto policy has lapsed now, I'm really diligent about reminding people of their policies because what happens now, what carriers do, and even Geico and AAA is doing this, is if your policy lapses by mistake because, oops, I forgot to pay the bill or I thought it was an automatic payment and it wasn't, the insurance companies now can see that you have a lapse. What they do is they put you through a vetting process of 15 to 20 days wait, which means you will be uninsured for 15, 20 days. I've had clients that have had to literally park their cars and Uber or take public transportation because we couldn't get them reinstated for 15 to 20 days. So that's where I'm saying is make sure you open all your mail because they give you 30 days notice if there's a billing issue for you to correct it. But if you're just ignoring all that mail, you'll never get to that notice on time and then they'll cancel you. I've had clients that have been canceled for 3 to 4 months and had no idea, driving around with no insurance. So I always tell people, open your mail. It's tedious and you could sure file it really quickly if it's nothing important, but the insurance companies will always give you notification if there's something that's going to happen like that. So, yeah.
Wow, I'm so thankful for your time. I mean, I think that a lot of people just don't have knowledge, especially for someone like you. You've been in the business a long time. You have a lot of great information to give. I think a lot of people just don't know what to ask. So you really did.
Yeah.
Great stuff.
Well, you asked great questions and you also are very knowledgeable. So it's helpful. And I think it's important you ask really good questions. So that's good.
How does anybody get a hold of you if they would like to just talk about insurance? And also, you guys, if I think Neda is great to just make sure if you want to just show her your insurance policy to see if you are paying too much or if you're not getting insured enough, because a lot of times people are not getting they're paying less in policy amount, but then they're not getting the proper amount of insurance. I've seen you save a lot of my people with like high premiums or just making sure that they got covered correctly. So I mean, that's something you do, right? You look at people's policy and
yeah, I can definitely review people's policies. I'm very honest. If I feel like you have a good rate, I'll tell you. Definitely, it's a little bit harder than it used to be because the market has changed a lot, but at least you have another eye that's looking at your policy. And some people are paying too much, and we are able to have some mobility with clients, especially if you're in a good location that's easy to insure, you don't have claims, you've had your auto ongoing with no lapses. Sometimes we do much better with rates because we do have multiple companies that we compare against. And usually email is best for me, which you can pass on. It's neda.aliveinsurance@gmail.com. And then I do have a landline office phone number, which is 650-997-2973. And that is always a good place if you need to reach out to me. If you want to chat, you could try to see if you can reach me. Most of the time I try to answer calls, which is it's a little rare in the industry, but I don't like phone trees. And you can always just leave me a voicemail. And then we do have a website for our office, which is Alive Insurance's website, which you'll see me as one of the agents there. And I am also on LinkedIn, and I'm linked with Fatima, so you can always find me there as well.
All right. Well,
Yeah.
thank you so much, Neda, for your
Thank you
time.
so much. Yeah, of course. Anytime. Yeah,
Guys,
anytime.
we are very lucky to have Neda and like available for our questions. So if you have any questions, feel free to reach out to me. I'm happy to make the connection if you know, unless you reach out to Neda directly. But thank you, Neda.
Thanks so much. Thanks, Fatima. You're amazing. I'll talk to you later.
Okay, thank you.
Bye. Thank you.